You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as from this here ever-expanding, ever-exciting Options Insider Radio Network. If you haven't checked out our latest additions to the network, and if you're looking for some basic options education, I'm guessing if you're listening to this show, you're probably not, but might be a few of you out there who want a refresher, then by all means, check out our Options Playbook radio show. It's with our friends over there at Trade King. We break down all of the option strategies you may want to use in terms of offensive and defensive plays. Really interesting stuff. Check it out, Options Playbook Radio. And if you're looking for something perhaps a little bit more hardcore on the technology side, and you're up in arms about the recent release of Michael Lewis's latest book, Flash Boys, and what HFT has to do with the markets and whether they're rigged against you and all the tech that goes into that, then by all means, check out Trading Tech Talk, another great addition to the network. We dive into all that stuff. In fact, our most recent episode was a big debate and discussion about all the different points there in Flash Boys. So if you're interested in that stuff, check that show out. I think you're going to like it. And of course, while you're doing all of that, make sure you download our mobile app from your app store of choice, the Google Play App Store, the iOS App Store, even the Amazon Kindle Fire App Store. We have an app version for every flavor of every handset out there. You can, of course, instantly stream all of your favorite programs from the network, download your favorites to listen offline on the subway or on the plane or wherever you like to listen to your programs. And if you're listening to something that catches your eye, you want to get some feedback in about that, hit that feedback button, shoot your questions, your comments instantly over to the hosts of your favorite programs. A lot of great stuff. The Options Insider Radio Network mobile app. I think you're going to like it. All right, and joining me on the old Volatility Views show, I have my usual suspects plus one extra suspect this week. Starting off with good old Jared Woodard beaming in from scenic and sunny and today kind of rainy, rural Virginia by way of Kleineman Financial Group and Condor Options. Jared, welcome back to the program, sir.
Thanks, Mark. I'm always happy to be here.
And also joining us from a little bit farther up the East Coast by way of Maine, none other than Mr. Andrew Giovinazzi from OptionPit.com. Mr. G, welcome back to the program, sir.
Thank you. Always a pleasure to be here on Volatility Views.
It's always fun to view some volatility, I find, especially at the end of the week. It's a good wrap-up to the week.
Yes, it is.
All right, and listeners, today's guest co-host is an old friend of the show, even though he hasn't been on in quite some time. If you've been surfing around the VIX blogosphere, the web for VIX over the past few years, you've undoubtedly stumbled across his website. Of course, I'm talking about Bill Luby, the founder of VIX and More. Bill, welcome back to the program. It has been too long.
Yeah, I'm glad to be here among the other suspects.
Yes, it's quite a suspect crew this week. Well, Bill, it has been probably several years since your last appearance here on the program. I know you've been working on a lot of different stuff over there at VIX and more, as well as some other projects. So why don't you go ahead and catch our listeners up on all the different things you've been working on, all the things you've been doing since the last time you joined us here on the Volatility Views program.
Sure, I'm juggling multiple balls these days, but the primary focus from a publishing perspective is still the VIX and More blog. I also publish a weekly newsletter and something I call evals, which is essentially a model portfolio for long-short volatility strategies. And at the beginning of the year, the end of last year, technically, I launched my own RIA business, and I am trading a volatility strategy as well as a more generic, for lack of a better term, stocks, bonds, and alternative investment strategy in that. So that's one of my new efforts, and which is part of the reason why I'm not publishing as much as I used to. Although I hope to return more to the publishing when I get when some of the dust starts to settle on that new venture.
So you're getting pulled into the dark side of asset management.
I am.
People always ask us here at Insider, when are you going to do that? Do you offer that? My answer is always no, because then I wouldn't have time to do all this fun stuff. But, you know, it is an interesting area, and I'm glad to see you're exploring it. Perhaps we'll have a chance to get into it in a little bit more detail as the show rolls along. But now it's time to dive right into our first segment, our Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, welcome to the Volatility Review, listeners. As the man said, this is, of course, a part of the show where we break down the week that was from a volatility and a volatility trading perspective. And overall, it wasn't a heck of a busy week, really, from a volatility perspective. We saw mostly a gentle drift downwards in S&P 500 vol, aka the VIX, with the VIX cash drifting down around that 13 handle and kind of vacillating around there for most of the week until at least today. We are recording this, of course, Friday, April 25th, listeners, for those of you playing the home game, and we're seeing a bit of a sell-off over there in the broad indices. The S&P is down about 0.75 of a percentage point, the other indices following suit, and so we're getting a bit of a bump today. VIX cash up about a handle, and the VIX futures kind of getting a bit of a bump as well, though perhaps not as aggressive as you may have expected. It's like most of the near-term futures up about a quarter, and the rest of the futures up commensurately in that range. We're starting to see, looks like, too, the near term of that futures term structure. Seems like it's settling down a little bit. It has been kind of vacillating quite wildly over the past few months, where you're just seeing it get bit up out of control and then crushed, and now it seems to be settling in line a little bit more. Bill, since you're our guest today, we'll give you pride of place. Give us your take on what caught your eye this week from a volatility and volatility trading perspective.
Well, if anything, it was kind of the absence of movement. We are seeing a little bit of that intraday phenomenon today, when the markets seem to open in a relatively calm fashion, and then suddenly the Nasdaq takes that huge intraday dive. But that doesn't seem to be stirring up much activity in the VIX. Of course, it is Friday. The futures aren't moving that much. It's just been a quiet week. I mean, we keep hearing about stuff going on in the Ukraine, but I think people aren't too concerned about that bubbling over in the short term, at least before Monday morning. And earnings, while not great, could be a lot worse. You know, the Fed training wheels are coming off, and people are trying to figure out what they should really be worrying about, I think.
Yeah, it's a lot of grasping at straws. What should I be concerned about today? What's the issue of the day? Jared, same question for you. What really caught your eye amongst this week's activity from a vol perspective?
Well, so Bill mentioned the Nasdaq kind of leading the market lower, and that's a theme that's gotten a lot of attention over the last month or so, I guess. But it's been interesting to me to watch how the divergence between S&P and Nasdaq vol has really continued. So if you look at the term structure of implied vol, either looking at just like at the money implied vols in the ETFs or indexes, or on the futures side, the vol future side of things, you get this definite, clear phenomenon where the short-term part of the Nasdaq curve is bid up significantly higher than the corresponding portion of the VIX, or even in the Russell. Things look a little bit more normal, and that divergence, which is historically pretty significant. I think we're at the highest difference between the two since at least the financial crisis, and that's really persisted even with some of the quiet trading we saw this week. That gap kind of remained open, and so that's something that I've been watching pretty closely.
And last but not least, Mr. Rock Lobster, what caught your eye in the week that was from a vol perspective?
I think people are tired of bidding up the vol into these, the crises that aren't. And I thought we'd get a little bit more. I'm not surprised. It feels like going into the weekend, there's really no decay. We'll probably have a lot of it on Monday if nothing happens. But they certainly are not taking the weekend out of the volatility, I would say. And it's also too, like, between S&P 500 and NASDAQ, kind of the old tech, old stocks, low PE kind of stocks, sort of hanging in there. And what's really kind of getting crushed still is the momentum stocks that are probably 20 to 25% off their highs. And, if you look at like the Netflixes and some of the other stocks like that, they're not kind of done yet. So, I mean, you have realized volatility in the momentum stocks, but you don't have a whole lot in the kind of the old school stocks. So it's just, I think people are starting to look at, where they have their money and taking some profits, moving it around a little bit. But yeah, the market as a whole, I think, 13 volatility is fair. 13 to 14 feels fair based on what we've been seeing lately. So everything is kind of fair-esque. At least on the old school stuff like the S&P 500. And I think volatility is justified in the Qs when you're moving 1.5% a day or something like that. 18 volatility or whatever is not too bad. So it seems like it's sort of pricing where it should be. But what I'm surprised at there's nobody's really bidding it up to any kind of premium at all. I mean, the indicator I use really the most is what the vol products are, and they are nowhere. They're in the bottom, in the lower rung of what's going on. So if people are freaking out, they're certainly not buying any, they're not buying the kind of protection that you would think. It feels more like they're just kind of rolling out of the Q-type stocks that are the high momentum stocks and into the S&P 500. And that's kind of crushing the volatility because it's killing one end, but it's holding the other one up. And I think that's what it feels like we're doing right now.
I like when you throw out the technical terms like fair-esque. Those are good terms. We need to borrow those here on the program. Bring in the big guns today, Andrew. I like it. Good stuff. But, I agree with you, though, about it seems like they're just keeping that weekend in because we're seeing a relatively pronounced sell-off, not as aggressive as some of the ones we've seen of late, but it's relatively aggressive sell-off going into the weekend, and yet there seems like there's pretty much just keeping that weekend in. They're not really doing much else with it. So you're right. It doesn't seem like there's a whole heck of a lot of concern out there, whether it's macro or international with the Ukraine or economic or given the rash of earnings we had this week. Doesn't seem like there's a lot of concern coming out of there. Of course, looking at the activity in the options for today, of course, a bit of a sell-off, so you're going to see heavy call to put volume in the VIX options. That's exactly what we're seeing today. It's about 4-1 right now. Looking at calls over puts, that's about to be expected. VIX is always call heavy anyway. Day like today, it's going to be more so in the call direction. But what caught my eye too is that total open interest number. It's starting to get precariously close to that 3-1 level of calls versus puts. We're sitting right now at 2.9-1. Who knows if by the end of the day, if this heavy call volume continues, we could hit that 3-1 number. And that seems to be kind of that magic level that a lot of people like to look at, where they start saying, something is in the works, something is cooking, something is lurking out there. The last time we got around these levels, we saw a pretty sharp pop shortly thereafter in the VIX cash. Bill, do you play a lot with these types of indicators?
I do. I don't spend a lot of time with the VIX open interest. I do look a lot at the, 3 to 5 day volumes. But I'm not one who reads a lot into the open interest. Now, perhaps I'm missing something huge here, but I haven't found that's a particularly useful indicator for what I do.
What about you, Jared? I know you're big into the technical indicators over there. Do you look at the call open interest? Do you agree that 3 is a significant level? Or you think it's kind of just more noise in the conversation around VIX?
As far as VIX option activity ratios, I looked at this. I guess it was last summer. I think it was trying to find some evidence whether that was a predictive indicator. And best I could do was conclude that it was coinciding certainly with big market moves. But looking at VIX option ratio versus forward S&P returns, I had a hard time finding anything really significantly deviating from normal. But that could change obviously based on who's in the VIX market and what kinds of activity we see over time. So it's not something I'm ready to shut the door on just yet.
My feeling about most indicators is that they only have any relevance when they're very widely followed and very widely held. This seems to be one of the more widely held ones in VIX land, which is why I tend to give it a little bit more credence than the myriad other technical levels and indicators that are tossed around out there on a daily basis. And speaking about VIX options, one of the other big additions to that VIX option landscape, of course, has been VXST. We're coming on I believe it's the third week or so now of those products being listed. So we're starting to see a little bit more development out in that space. And Bill, this is of course the first time you've joined us since the VXST options were listed. What's your take so far on the product in general? Does it intrigue you, or you want to wait to see if it develops a little bit more volume?
Yes to all those. I'm very much intrigued by the product. I like the idea of having a 9-day product that is an interesting overlay on the weeklies. I do think, given that all the activity in the VXX weeklies, that to some extent the VXXT is fighting an uphill battle to kind of reach that tipping point where it's going to attract the short-term traders. But I do think, because of how quickly it moves, almost twice as much as the VIX and sometimes more on short-term moves, that it has the potential to become a darling of the short-term trading crowd. But we're clearly going to need to see a lot more liquidity for that to happen. I realize it's gotten off to a slow start, and that's got some strange alphanumeric symbology that's taken a while to, for some of the brokers, I guess, to code into their systems. That's not helped either. But I think this product is going to have a chance to move, and I would really like to see it, because I think it opens up some fascinating pairs and other trading opportunities.
That's a good point you raised there, Bill, about the VXST options. It seems like it's an interesting conundrum with this product. This one in particular, we see this with a lot of new products, but with these products with so much interest in them, so much hype going into them, and they finally launch, and it's kind of like a resounding meh, as I like to say here on this program. Everyone's interested, everyone's watching, no one's touching them. Do you think a lot of that can be laid at the feet of that symbology? What do you think really is attributing to the relatively scarce volume we're seeing out there right now?
Well, these things, there are different inflection points for all these products. And, you probably remember, I remember when VXX launched, that for about the first 2 weeks, I could say I was trading 50% of the product, which actually meant moving very little money at the time. But it took probably 6 to 12 months for it to even be liquid enough for most people to be comfortable. I say most people, most traders be comfortable trading. It was probably more than a year before I think in the institutions could really feel comfortable without dominating that market. But once that hit a couple of tipping points, it did take off. I think VXST has that potential, but it's not the first. It doesn't have that first mover advantage in the short-term volatility space. So again, it is to some extent fighting that uphill battle against VXX, which is already entrenched. Obviously a different product, but if we see the VIX go to 25 and someone sees that VXXT triples or quadruples, then that may dramatically increase the interest in that product.
Yeah, I've heard a lot of people say that it takes a long time for these products to get ramping up. And they point to, of course, the long ramp up to VIX Futures and the ramp up to VIX options, and like you just mentioned, VXX. But we are, of course, in a little bit of a different environment now. We're in a world where VIX dominates the headlines. Products like VXX and VIX options are volume leaders on any given day. So they're jumping into an already very busy, very, very volume-heavy ecosystem. So you think they would catch on perhaps a little bit quicker. Again, it's only a few weeks in, so we still have plenty of time. But I think a lot of people are surprised, at least initially, at the scarcity of volume out there in that product. Jared, is that your take as well? Are you still surprised that they're not putting up the numbers a lot of people expected out there in VXST?
I don't know. I kind of expected a little bit of a slow start with some gradual adoption. We have that working model. A lot of people think of these products as linked to what happens on the ETP side in terms of tradable, shares. And I think that if you get VXST incorporated into some ETP, whether as a straightforward kind of vanilla product or one of these sort of structured versions that we've seen, I think that could drive some volume as well. And I think it also would help the product anyway, maybe not the market, but if we had some real significant volatility in the market, talking about a cash VIX at 25 or 30, then I expect that would drive a lot more volume.
Mr. Rock Lobster, same question for you. We haven't had you on for a few weeks. You haven't had a chance to really pontificate wildly about VXST and declare it a success or failure in these early weeks. So go ahead, sir. The floor is yours.
How long did it take for the VIX to catch fire?
It was several years.
Yeah, okay. I was just checking so it's always, how I always teach people about trading options is you got to establish relative value here.
How dare you bring rationality and time perspective into a weekly program, sir?
You know what? I know that really steps on your toes, as lovely as your toes are, and I kind of agreed with Bill there. Once you see that once we have that real front month spike where, VIX is up maybe 2-3 handles and the VXST is up 10, people are going to go, oh, wow, that thing moves. Now, who knows where the actual options are going to be priced when that's happening. But nonetheless, movement attracts people. Non-movement does not attract people. So, it's just the SIBO will support it. It's probably not that hard of a product for the VIX guys to hedge, especially when the markets are about 50 cents wide. And it'll keep going until it starts to do something fantastic, or some big players actually start to step in and they kind of figured out how it works, and they start, what I would think really was be some institutions probably trying to come up with some sort of clever arb versus VIX, depending on where things are, and trying that route to start some volume jumping in it. But right now, I think it's pretty early, and they're really honestly not quite sure how the product's going to react.
And just to play devil's advocate too, all the things Bill raised are correct, with the symbology issues causing a lot of hiccups at a lot of brokers, keeping them from really pushing it to their clientele. And also, it's been an odd time to launch a new volatility product because we have had a few significant movements in volatility since then, and it's kind of almost counterintuitive, but when you're still shaking everything out systems-wise, you maybe want a little bit quieter period to make sure everything works, and they launched it on a day when the S&P was down over 1%, so it hasn't exactly been the smoothest period to launch a new volatility product. So, of course, we have many, many more weeks to ponder the success or failure of that product. Meanwhile, we're going to keep moving on. Another index that seems like it's cropping up a lot more on the show of late. We had a couple of listeners write in about it about a month ago or so, and ever since then, it seems like it's been popping up on our radar more. And I wanted to bring it up, too, because our co-host from last week, Russell Rhodes, I believe he's over there right now working with these folks. Of course, I'm talking about the India VIX, one of the few international VIX licensees that seems to really have captured any attention, any mind share in the broad investing public. Well, they hit a new record high this week of 38.04. That was earlier this week on Monday. They've dropped since then, but they hit a nice spike then. And I believe our buddy, like I said, Russell Rhodes from the SIBO is over there right now working with those guys and looking at some of their data and trying to figure out how they can help disseminate more information about what's going on over there with the India VIX. But still, interesting to see that this product is starting to catch some mind share, catch some attention. So that's always an interesting thing to see. And I know, Jared, you factor a lot of the international volatility in the developing world into a lot of your research you're doing over there at Klineman. So has this caught your eye, this spike here in the India VIX?
It has. In fact, I was just updating that global volatility heat map that we update earlier today. And I think this was data through yesterday had the India premium actually higher than any other country we track. And I'm speaking specifically in terms of the vol risk premium, the ratio of 1 month implied versus 1 month historical, ranked in terms of 2-year percentiles. So we can kind of scale things and compare apples to apples. And the premium in India and then also in Mexico was higher in terms of percentile ranks than any of the other countries that we watch. The USA was actually bringing up the rear there with the lowest ratio in that ranking.
And of course, since we're on the international tip, we'd be remiss if we didn't also hit another index that is hitting the other side of that fence, which is, of course, the Kospi, the 200 Volatility Index. I believe you've touched on this in the past on the show there, Jared. They're hitting the other side of the fence. They hit a record low just a few days ago. They've fallen about 7.5% over the last 3 months. Of course, if you're not familiar with the Kospi, this is the volatility in the Korean-based listed equities over there. So interesting one to watch. And again, it's interesting to see big publications like Bloomberg and others starting to track the developments in these developing world volatility indices, because it shows that there is a more global interest in things outside of VIX. Obviously, we talk about VIX a lot on the show. Bill, you've built a nice little franchise over there around VIX, but there is more to the world of volatility, and we like to make sure we highlight it here every now and then. Do you include the Kospi there in your global volatility tracker there, Jared?
It's something that I watch. It's just it's a little bit harder to get that data. As a matter of fact, the exchange keeps a little bit tighter lid on it than some of the other exchanges around the world. But I do check in on that from time to time, and it's anybody who pays attention to East Asia, even just for general investing purposes, I think has South Korea on the radar. So adding a volatility component to it, while South Korea has had so much success versus some of the troubles in China and Japan, I think it's definitely something worth watching.
And Bill, I know you've been watching a lot of the emerging market vol for years. On VIX and more years ago, you were writing about the early days of the India VIX. So has the growth and development of that marketplace and its entrenchment in the mind share of volatility, has that surprised you at all, or is this something that you've been anticipating for quite some time here?
Well, I think the whole issue around here is the election, and it's kind of fascinating when you think, and the India VIX uses the same 30-day, forward-looking window to calculate their volatility as we do here in the U.S. with the VIX. So when you have the elections and the results, I think are due out. Was it May 16th? That's in the back of my head. That we're going to have the results of the huge elections in India, that suddenly when you creep into that 30-day window, the volatility starts exploding, because now you're including the day where you're going to have the results of that huge electoral process part of the calculations. And so you see the spike. You see this in the U.S. when every event is coming up, but I think it's interesting that you see it in India with a specific event, and you see this huge spike, and it's created a lot of interest. Whether, once the elections are over, whether people are going to pay attention to the India VIX, I'm not sure. But we've got, the VX EEM captures the entire emerging markets universe. I look at the implied volatility in Russia as a very timely way to keep track of what's going on over in the Ukraine. So I get a lot of value out of some of these emerging markets volatility indices.
I got a question. Is that a India VIX tradable? I mean, one of the best trades we have this year is when, we get those event spikes in volatility, and then you get to play with the Vega without the Gamma. Is that so? We would have to. Yeah, I got to open some Indian account to sell the heck out of that right up into the election.
I believe that market is closed, but Jared, I don't know. Does anyone have any more information on that?
I don't think there's any volatility products as such there.
Oh, so we've got the opportunity of the year with vol spike before an election, and we can't do anything. Well, that's aggravating.
EPI has a reasonably good options volume in there, so you could construct something around the India ETF if you want.
Yeah, I don't like the messy Gamma part, but I could. I'm looking at it. It's kind of EPO. Yeah.
Not a huge amount of volume, but
I was excited, but my ardor has now cooled. But if that obviously I think would be a very interesting trade, because it's too bad they've got the index, but they have no product, which is that's annoying. I'm now officially annoyed by the show. I was excited for 2 whole seconds, and now I'm not.
Well, there you go. Well, the other side of that coin, just to make you a little happier there, Andrew, is that there are the futures indeed on the India VIX, and even though we saw a spike in the volume, the actual trading volume on those India VIX futures not exactly lighting up the old tape. Maybe that's why Russell is heading over there right now. The National Stock Exchange's futures, their volumes are down nearly 60% since the loss. A lot of people are saying that it's the implementation of it. They have a lot of fees, a lot of costs associated with those. That is kind of keeping people away from that. But still, not exactly the trend we're seeing in volatility products across the board. You come over here to the domestic volatility market, and VIX options, VIX futures are setting new records on an almost daily basis. It's pretty much a predictable headline, copy and paste, new record for the VIX. And yet here is one of the more tracked and watched international components of that, international licensees of that. And when they actually launch a tradable product, like what you're just talking about there, Andrew, so far at least, not a lot of uptake on that. But again, when you get into the international markets, a lot of it gets into the contract specs and other things. You know, a lot of people have been talking about the launch of listed options in April there in China, and we're hearing a lot of pushback from there as well, that the multipliers are going to be not exactly conducive to wide-scale retail adoption. We'll have to wait and see there as well. But a lot of times the devil is in the details with these products when they're listed overseas, and it takes a while to shake all of that stuff out. All right, great stuff on the old volatility review. And now, because so many of you are taking the time to write into the program, we want to make sure we give you some time here on the show as well. So we're going to jump right on into our volatility voicemail segment.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody. Like the man said, a lot of great ways for you guys to get in touch with us here on the old Volatility Views program. Make your questions or your comments heard. Just like our first listener here, Mr. Sanjay Patel, he writes, I have to agree with the hosts regarding the discussion from episode 104 regarding VIX ETPs and RIAs, or family offices. I have been active in the advisor community for several decades, following all of the latest research and attending many industry conferences. I've never encountered a single study or panel devoted to this issue or a fellow advisor who utilizes these products. Granted, my evidence is all anecdotal, but I would like to think that if advisors made up a significant portion of those flows, I would have encountered that by now. I just wanted to share my thoughts with your listeners. Thank you for reading my question. Please continue to produce this fine program, as well as the advisor's option. They speak to a very unique audience. Well, you're welcome, Sanjay, and thanks for taking the time to write in. And this is an interesting conversation. Like we said, we had it a few episodes ago. Bill, it'd be good to get your chance to weigh in, too, because I know you were down there at RMC. And what our listeners is referring to here, Bill, and to the listeners who may not have heard the earlier episode, is we discussed some research that they presented at RMC. I believe it was by Manish Dipandi out of Barclays, where he was talking about what constitutes the flows in a lot of these big VIX ETPs like VXX and XIV and all these other ones. And a lot of the assumption in the past has been there's a lot of retail floating around out there, as well as some institutional and others. And yet he came out there and said retail has some presence, but a large part of the flows out there are these RIAs and family offices. And when we discussed that a little bit on the show, because kind of like our friend here, Sanjay, all of our anecdotal evidence that we've seen and gathered is kind of to the contrary. We, of course, do an advisor show here on the network, and we talk to a lot of advisors. We're pretty active in that space, and I can probably count on one hand the number of advisors I've talked to who are even cognizant of the existence of these products. And it is possible there is a very large universe of RIAs and family offices out there that are utilizing these products as some sort of surrogate because they can't get derivatives exposure. They don't want to have derivatives exposure in their funds, and they're just flying under the radar. That is certainly possible. It's possible Manish has some data we haven't seen, and we're going to invite him on the show to discuss this directly. But it is nonetheless kind of interesting to hear that kind of data. And Bill, like I said, you were down there at RMC. What was your take on this presentation, if you had a chance to check it out, from Manish about these flows going into these VIX ETPs? And does his data coincide with what you've been seeing out there? Do you see a lot of RIAs like yourself floating around in the VIX ETPs?
First, I think Manish's presentation was one of the highlights for me, at least, of the entire conference. And last time I checked, it hadn't been uploaded to the
Yeah,
to the CBOE
we're waiting
site,
for that one to be uploaded so we can get the exact specifics of what he said and put them out there for our listeners, and they're holding on to that one for whatever reason. But I agree with you. That was my favorite one as well.
And I have heard over the years from a number of RIAs who have expressed interest in the products, and I certainly have a number of those who are subscribers to various services. But I think now that I've actually put on the RIA hat and kind of understand a little bit more about my competition and what others are doing out there in the space, I don't think the RIAs, I think there's a niche available to RIAs that they should probably be looking at, and that would be what I call the VIX strategy ETPs. These are, and stop me if I'm getting into too much detail or too whatever, this would be the PHDGs and the VQTs that are based on the vector index, and they dynamically rebalance a portion towards volatility products, or the VIXH, which has an exposure to VIX call options, or some of the other products as well. These are the types of things you can actually leave in the portfolios and, do the quarterly rebalance and not look and realize that's, unlike VXX, suddenly it's gone down 40 or 50% during the quarter when it comes time to rebalance. So I think there are some, for the actively managed RIA, I think there's a good portion of the VIX ETP landscape that is usable. But I think for the most of the RIAs that are doing quarterly or annual rebalancing, I think there's only a small subset that they should focus on, and I don't think they understand the potential value of adding a handful of these products, or even how they work, frankly.
Yeah, my fear is that if they are trading these things, they're just buying and holding VXX for months at a time.
Exactly.
And as we've said many times here on this program, that is not exactly conducive to long-term returns. But c'est la vie, interesting stuff. We're waiting to get Manish on the show, or at least get a hands on his presentation, so we can dig into that detail, or dig into that data with a little bit more detail. But great follow-up there, Sanjay. I think all of us here on the show pretty much agree with you that anecdotally, at least, and there isn't a lot of hard data out there, so anecdotally at least, it seems like that doesn't really appear to be the case. But we're always waiting and willing to be proven wrong here on the Volatility Views panel, like Andrew is every week. I'm just teasing. All right, next up, we have a question from a listener, Even Star. He writes, is it possible to run options valuation models using actual rather than implied volatility levels? I think this would give a truer approximation of the option's value when you strip away all the nonsense that comes from implied volatility. A good question, Mr. Even. This must be a theme this week. Some people writing in some other shows with similar questions on the network this week. I'll tell you what I told them, Mr. Evan, is that you're free to use whatever volatility you want in your models. Volatility is the fudge factor, for lack of a better word. You can set it to wherever you want. Just be cognizant of the fact that if you do use realized as opposed to implied, you're going to be selling a lot of options, because you're going to be dramatically undervaluing pretty much everything out there, because as we've said many times on this show, there is that risk premium in the marketplace. Implied is 99.9% of the time going to be higher than realized volatility for many different reasons. And if you're always setting your levels to realize, you're going to be dramatically undervaluing those options. It may work. You may want to do that just for a historical perspective to see where things should be. And it may be interesting from an educational and theoretical perspective. But if you're going to trade off that, then hopefully you would be cognizant of that differential, so you're not out there just blasting away premium willy-nilly. Bill, what do you have to say for our friend here, Mr. Evenstar, who wants to trade only off realized vol?
No, I thought your comments were interesting. That if you want, I think it's a great exercise to go through, particularly for someone who is relatively new to trading options or as an intermediate level. Just start plugging in your own volatility estimates based on either historical data or some sort of take that's different on the implied volatility, and see what sort of how your options price differs from what the current implied volatility model is spitting out. And when you start to see the differences, then think, well, gee, maybe I should be selling more options if the models are historically overpricing them, or maybe I ought to rethink about how I'm going to value volatility in my models. I think it's a great exercise to go through, but yes, don't build an entire strategy around the numbers that get spit out, but it's a great food for thought.
Yeah, I would echo that too. I mean, there's a sense in which anytime you trade a contract with a view towards making a profit rather than just maybe offloading a risk you don't want or something like that. But anytime you're making a trade where you think that the market's got something wrong, or the efficient market hypothesis isn't going to hold in a maximally strong sense, I think it's safe to say that that's functionally what you're doing anyway. You're kind of taking a forecast vol that differs from the markets and trading along those lines. So I gotta agree completely that it's a great exercise and something that we're all kind of de facto doing anyway.
And particularly around earnings season, a very interesting time to do that.
Yes, when we did the earlier incarnations of this show, our partners here at Volux were big fans of volatility cones. That would certainly play into this as well. You could see the different levels of the volatility that you're actually trading, how many standard deviations away from the mean you are, and that could also come back to play when you're looking at the vol levels you're actually trading. But I agree. This is I don't want to dissuade you from doing this. I just don't want you to trade off this. Just use it for informational purposes only, perhaps, we'll say, and then go from there. All right, next up, we have a question from a listener. Goes by the handle Hawkeye, and he writes, aside from Apple last week and Google last cycle, it seems like most companies are dramatically underperforming their straddles during earnings season. Bill, this gets back to what you were just saying about the realized vol during earnings. He goes on to write, Microsoft and Amazon are simply the latest names to fall victim to this trend. To what do you attribute this trend? Why are traders so consistently overestimating volatility going into earnings announcements this year? This would seem to be a good environment for a risk-defined premium harvesting strategy, such as an iron condor or an iron fly. Well, I have a lot to say on this one, but Jared, this one seems like it's tailor-made for you, so I will toss it over to you first. What do you have to say here for our friend, Mr. Hawkeye?
I hate to be the guy throwing cold water on good questions, but I'm not sure that there's anything that I've seen going on that's not just a sort of idiosyncratic point in the cycle. A lot of times when I've seen a handful of studies that have looked at this sort of question over the long term, and that usually they find that once you kind of net things out over time, that options, that selling premium or buying premium with a view toward it being systematically under or overpriced around earnings tends to be a kind of a zeroed out strategy, so that you need to have some view about the underlying to really do anything worthwhile. That said, there has been, I think right now, a change in sentiment such that people are more nervous about growth stocks, especially tech stocks. And so if we do see, the options bid up excessively ahead of earnings, I think that would kind of make sense given the change in sentiment lately. Whether that's something that's going to persist over the next 2 or 3 quarters, I think is a probably trickier question.
Yeah, I mean, obviously what he says sounds interesting anecdotally, but does that agree with your data there, Jared? Do you think a lot of the names in the aggregate are underperforming their straddles right now, or is he just looking at a couple of the high-flying names and perhaps getting a misperception as a result of those?
I would lean toward the latter. I mean, I've got a few tickets here that would suggest that earnings haven't been totally underpriced all the time. Enough losers to confirm that view, which is just fighting anecdotes with anecdotes. But like I say, the longer term studies that I have seen suggest that usually over several earnings announcements for most stocks, the options don't tend to be dramatically under or overpriced either way, and it helps to have instead a view about the underlying if you're going to trade around earnings.
Now, Bill, what's your take here for our listener, Mr. Hawkeye? Do you agree with him? Do you think the names are underperforming their straddles, or again, is it kind of a high flyers giving the wrong perception to the rest of the crowd?
Yeah, I think it's hard to make generalizations about the market now, in that we have, a group that are momentum names that keep getting hammered and that have huge implied volatility. We have some cyclical names that are trying to figure out what's going on in China, and we have some, more defensive names that are pretty much treading water or making small gains. So rather than having one stock market universe, I think we really have one that's much more bifurcated than usual. So yeah, I tend to agree that, and I don't do a lot. I should probably say that I don't do a lot of trading around earnings. I look a lot of options IV into earnings, but not play the actual earnings announcement. So I really find it difficult to generalize from these. And of course, if you generalize on a couple of them and miss one name, you can miss by a large and expensive margin when you're talking about some of these straddles.
All right, and last up for you, Mr. Andrew, what do you have to say to our friend here, Mr. Hawkeye?
Well, Mr. Hawkeye, all earning straddles are is just best guesses. So, and it's however the company performs. So I think there'll be times, it's just anything else, cyclical, in and out. I've seen a lot of guys trade the earnings well, both buying and selling premium, but you got to do a lot of earnings names to kind of make the whole thing work out. So picking and choosing one or two, it's just a dice throw anyway. Did just some underperform this time, and then next season they won't. So I don't think there's any, after watching earnings cycles since 1989, not much has changed. So, I think this is just you're looking at them. There's not, let's just put it this way, not as much has changed, I think, to make it a real, to change the way you might trade these cycles. That's all I would say there.
All right, great question. And like I said before on the show, there is a surprising paucity of actually good data and research on that subject. As important as you think it would be, the performance of straddles over time, there aren't many people actually cranking out those numbers, which is something that I've always found interesting. And if we had the time here at Inside, I would love to do more of that, because there definitely is a need for that sort of research. All right, moving on. We have time for one more question here. Our last one comes in from a listener named James Norman. He writes, "Love the Volatility Views show. Great content, great guests. Keep them coming." Well, thank you, James. He goes on to write, "I would like to ask a question about tools, in particular scanners. You've discussed scanners for unusual activity and changes in implied vol on previous shows. Do you know of any tools that scan for changes in implied volatility skew? I'm looking to capture skew distortions that allow me to leg into verticals, ratios, and risk reversals at highly attractive levels. Does such a tool exist? I didn't know where else to turn, but I know Mark and the Volatility Views team won't let me down. Sincerely, James." Well, great question, James. This is something we've talked about a while back, this type of scanner, and we actually did some looking into this a while back to see if there was something like this. So your question is somewhat timely in that sense. And what we found looking around, and maybe you guys have different takes on this here, is, we found that there are obviously a lot of great scanners out there with a lot of pre-built, predetermined scanners. You can do change in volume, change in IV30, all that kind of stuff. None of them really have anything pre-built that fits this mold. You have to go out and really design your own customized scanner. Now, that said, there are a lot of ways you could do that. It really depends on the flavor you're looking for. You could maybe set up a custom scanner for the change in IV for a 25 delta call. Again, most of the people are looking for stuff in the call wing. You could do it in the put wing too, if that's what interests you. Most people looking at individual equity options seem to be focused on upside skew, so that's kind of where we focused a lot of our efforts. You can do change in that 25 delta call. Maybe if you want to do ratios, you can do change in that ratio between the 25 delta call and IV and the at the money. That's getting a little bit more down the rabbit hole a little bit. But there are ways you could configure this yourself and scan for these types of changes. But outside of that, I haven't seen any kind of off-the-shelf thing that you can just plug right in and start scanning for skew distortions. Maybe you guys have. Bill, have you seen anything that would fall in line with what our friend Mr. Norman here is looking for?
No, I haven't stumbled across anything like that, but it sounds like an interesting tool. I, do refer to the skew index, but that's pretty generic, high level, and I find that has some limitations in terms of translating that into strategy. But I think James is asking the right question here, and that seems like an interesting tool for someone to develop.
No, I mean, I invented that 3D tool to do just this. It works great. What I do need is better data. But it definitely shows you when the skew is kinking anywhere. And what I'm trying to get is just lining up a data provider. But it definitely shows you like how the skews change from, let's say, the close of yesterday to right now or down the road. It updates about every 10 minutes per day. And it's just depending on the products you follow. So right now, it really is only showing you one product at a time. So like you pull up the S&P 500, you can see how the skew changes for the S&P 500. Works pretty darn good.
Now I remember it did volume per strike, but it also will graph the skew for you too. I didn't know that.
Yep, implied volatility for strike. So you can see like a color shift in the way like the little buildings get taller when they change in implied vol's higher. So you definitely can see when the shoe is starting to kick. And as far as strategies go, I could see a way to program and create strategies to execute, based on kind of relative skew levels, different kinds of ratio spreads and stuff like that. That's sort of what we teach anyway on just people trying to think for themselves to figure that stuff out. But the technology is out there. I think, yeah, it would definitely be one of the more useful tools ever. I know the data is out there. I know the front end technology is out there because I helped develop it and got a patent on it. And that's what I've been trying to put together for about 5 years now. But it's almost there. But again, without a dedicated real-time data provider, it's tough to get it to the level because the historical data is there. So it's our option vision product, and it works pretty good. The biggest problem, what we only do though, is day-to-day skew change. I can't do day to week or day to 3 days. I would like day to day, day to 3 day, day to 5 day, day to a month, so you can see how the curve is changing for any term. And again, like I said, it's all the pieces are out there. It's just putting them together and dealing with the myriad of the biggest problem. Just to answer James, is data contracts for any kind of real-time data. It's just there's so many hoops to go through to sign data agreements and get that data from the exchanges and stick it in a place and put it in the product. Really very difficult. Not very easy.
Listeners, if you want to know more about what Andrew's talking about there, it is, of course, Option Vision. He mentioned the name by a company, Acumen, Acumin. So search for that online. You can find out all that good stuff that Andrew is talking about there.
Oh, okay, I'm sorry, but Bloomberg has it. It's just the problem is it's not giving you the call skew versus the put skew. They're always stuffing them together, right? So you're not getting really clean skew lines on puts and calls separate, which is how people that trade skew trade in the first place. So, the put skew doesn't mean anything once you start attaching the call skew to it, because you never know where that really is. So I think always the more useful way to look at skew to me has always been I separate the call side out and the put side out and sort of judge them independently before you judge them together. The problem is everybody just wants a data point, and it's very easy to say, oh, the skew index is here, the skew index is there, without real regard to what those things are measuring. Because sometimes the world for puts, as you guys know, are totally separate than the world for calls. So anyway, that's, yes, James Norman, I think it would be a great product to have, and I'm very close to getting what I want, just to let you know.
Great questions, as always, everyone. We love to see those questions. Keep them coming. But now we have to roll on into our final segment, the Crystal Ball segment.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the Crystal Ball.
All right, everybody, welcome to the Crystal Ball. Bill, I know it's been a while, but this is the portion of the show where we prognosticate wildly, indeed even recklessly, about what's to come for the week from a volatility perspective. Since you're our guest host this week, I'll give you pride of place, let you go first. What are you looking for coming down the pike, whether it's VIX, whether it's NASDAQ vol, wherever you want to go from a vol perspective? What are you looking for?
Well, next week is a huge week in terms of data. We've got, the FOMC, which probably will be nothing, but it could be a shock. We've got the Q1 GDP out, and then we've got the ISM, and then we've got the employment report all in 1 week with earnings layered on top of that, and maybe some clarity on Ukraine, maybe not. So I think there's potential for some pretty large moves next week. I'm not anticipating one. I do think that VIX in the 13.5 to 15.5 range makes a lot of sense, but there's quite a few things that could upset the apple cart in a hurry next week.
Jared, what about you? What's catching your eye in all your variety of research and indices coming up next week?
Okay, so we talked. I think I mentioned last week that premium in Brazil was looking a bit rich, and the ETF anyway has been trading kind of sideways for the last week or two, which is the reason why it looks kind of rich. If you see that continue, I think that option sales there are going to stay pretty attractive. The data, I agree with Bill that the data next week is key. One thing to watch, I think, as people start thinking about the Fed again, is that the reverse repo program that they announced last year has been ramping up really steadily, and is now kind of actually overwhelming what they're doing on the taper side of the equation, on the quantitative easing side. And that's a net positive, because it means that the Fed's kind of stepping away even faster than I think a lot of people realize. And if that pace continues and the data is consistent with that, I think there's probably a lot more upside to equities this year than has been reflected so far. And accordingly, option markets, I think, have some pretty predictable consequences if all of that shakes out. And so if we do see the Fed stand pat and the reverse repo program keeps ramping higher with neutral to positive economic data, then I think that's a good thing in general.
Andrew, take us home. What are you expecting for the week to come?
Well, we've got real simple. We've got events that are going to probably edge volatility higher, but unless we have something really fantastic, we're probably not going to get much higher. The thing I will say, though, is just where the levels are right now on everything, I think they're just kind of at that classic knife edge point where, if we just get that extra little push, it's going to take just a very little bit of a push to really send a sharp arrow up everybody's keister when it comes to volatility, because vol is very low. All of the implied volatility levels are relatively low, and those things can change so quickly now that I would just what I tell my clients and students is, after buying and selling volatility for a long time, you don't want to be the first vol sale. And I don't think we really had much of a volatility move yet, based on what's been a pretty good smacking of the Qs. So you don't want to be the first vol sale. If you don't sell it, you're still going to live. But I think usually we'll see something else by next week, somewhere or the other, and that might be an opportunity. But I would be surprised with implied volatility really going substantially lower with the realized vol we have now. I would find that a shocker. I'd be shocked, to be honest.
Well, you are easily shocked, sir, but we'll leave that for another week, because that's all the time we have for the Crystal Ball segments. Also all the time we have for this episode of Volatility Views. But before we go, really quickly, let me check in with each of my cohorts here on the old Volatility Views panel, see what they have cooking that may interest you, the listener. And Bill, since you're our guest this week, you get to go first yet again. Tell our listeners what they can expect, what's coming down the pike from VIX and More and all the other fun stuff you're working on over there.
Well, VIX and More has been somewhat quiet because I've kind of dove into the deep end of the asset management business. So we're going to bring that back to life, breathe some life into it. And I think you'll see a lot more. I'll be a lot more active on the publishing side. And so, expect more of that. And the asset management business will be moving forward. I'm not sure if I have anything else in specific to announce at this point, but a resuscitation of the publishing side of my life, I guess, would be the short answer.
If people want to find out more about the asset management you're doing, can they find that out at VIX and More, or is there a separate destination for that?
Right now there is not a separate destination, but I will. Yeah, they can email me or or ask questions through VIX and More, and I can set that up. We'll eventually have a website up, but not yet.
There you go, listeners. He's making you work for it. But if you want Bill to manage some of your money for you, just jump through some hoops over there at VIX and More, and eventually you'll find him over there.
That's the story, and I'm sticking to it.
That's how you know you're getting a really motivated, quality client at the end of the day, Bill. I like it. Put some hoops up there. All right, Jared, what's coming down the pike from Klineman Financial Group and Condor Options?
So at Klineman, we're doing a good job of not losing any money, and then sometimes making a little bit. And at Condor Options, we've got the Iron Condor newsletter, which is a great way to get into if you're sort of novice to intermediate trader wanting to trade some multi-leg spreads. It's been doing really well, and I think we've been able to provide some good educational content in addition to that. And then the volatility tracker research product has been people seem to be really liking that, and so I'm continuing to look for interesting indicators and good trade ideas on that side of things.
And last but certainly not least, Mr. Lobster, Mr. Andrew Giovinazzi, what's coming down the pike over there at optionpit.com?
Well, after forever, we started trying to get our chat service rolled out. for people who basically just want to come in and ask questions. That will be in addition to our Option Pit Live service, basically where we look at market conditions during the day and look for a trade that might make some sense based on what's going on. But we will keep a chat room open for a couple hours so our clients can talk with each other, talk about trades, share ideas. When weird things happen, like the Apple split, how's that going to affect my position? We got pretty good bank of brains with our current clients. I don't know if I want to count Mark and myself in that, but yeah, I think it'll be a nice service. It's mostly what people have been asking for. So that's what we're going to be rolling out. And also, I believe I think May 7th, we'll be doing a little webinar on why you need to take our gold course. That way, people actually, if you want to understand about some of the things we talk about on the show, and it's not quite making sense to you, we do a pretty fair job, I think, of educating people. So stop on over to optionpit.com, click the little gold button on our website, and you can start learning about options pretty darn quick.
All right. Thank you for that, Andrew. And of course, on behalf of all of us here on the Volatility Views panel, we want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the program, and especially for writing in with such great questions. Keep them coming. I love you guys. I love all of our audiences on the network, of course, but you guys at VolViews really take it to another level, and we love to see that. Keep those questions coming, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.